The floor is yours.
Okay, thank you so much. Welcome, listening audience. This is Everett James, your trusty tax reporter, who comes on every Wednesday morning at 10 a.m. for approximately an hour or perhaps an hour and 15 minutes, depending on the preferences of the listening public. Keep in mind that we are here to serve you and to meet your needs. So, in keeping with that objective, we invite you to phone in or email in your questions and comments. Feel assured and be assured that we will deal with any questions in the following week's program. And to as a little reward for those who do take the effort to call in or even email in your questions. This promoter and the broadcaster will be available for a free online consultation for your 2023 tax return. And if there are any other needs that we can discuss, what I can do to help you. So, with that in mind, my phone number is 951-522-9877. To repeat, 951-522-9877. And for those who would like to use email capabilities, evjtax1 at gmail.com. We'll repeat, only using the numeral one, not spell it out. EVJTAX1 at gmail.com. Okay, the topics that we can share with you are part of a regular weekly update from IRS. And so we'll go through this fairly quickly, uh, and I will attempt to repeat the information that is given. So grab your pen and pencils. The information you'll find very, very valuable, particularly to those persons that the information applies. Keep in mind that the IRS wants to remind all of the taxpayers who are living and working outside of the United States that if you're outside of living outside of the United States and working outside of the United States, you have until Monday, June 17th. And guess what? That's only less than 2 weeks off. But June 17th is the deadline for those individuals. The deadline applies to both U.S. citizens and resident aliens abroad. The And that includes those with dual citizenship. There is a extension for folks who use the free file program. IRS announced an extension of the current free file program through 2029, and that's after an agreement that will continue to make the free private sector tax software available to taxpayers. So, under that particular free file program, you will be using a private um, uh, company software. The 5 year extension was between IRS and the Free File Incorporated through October 2029. Now, this free file program is only available on irs.gov. IRS reminds taxpayers to stay alert for scam artists. Don't fall for these scams centered around currently the fuel tax credit, the sick and family leave credit, and household employment taxes. So the scammers look for areas that are not um, currently being closely monitored by IRS. IRS has received thousands of dubious claims where it actually appears that folks are claiming credits for which they are not eligible. And that leads to a lot of refunds being delayed and the requirement for taxpayers to come up with additional documentation to support their claims. Taxpayers who file these claims, mistakenly and are not really eligible to follow the steps, they need to verify their eligibility. This is part of the IRS's what they call a dirty dozen series. Okay, check the status of your refund. Hopefully, that most of you have received. You can track that refund very easily and conveniently with IRS's Where's My Refund? And that's the tool that's online at irs.gov/refunds and using the IRS To Go application. So that's the actual location is at irs.gov/refunds. And you're using that, as they call it, the IRS To Go application. The refund status usually becomes available within 24 hours. So it's not, don't expect to get an immediate, 60-second response, but it does take at least 24 hours of processing. And when IRS does respond, they'll let you know that they got the e-filed return. Of course, this does not apply to returns that are filed on paper. There, you're just taking your gamble with millions of other paper filed returns. IRS will notify you, of course, on those who filed paper returns. And in some cases, there are just urgent reasons that you can't file electronically, so you use a paper return. And that is actually the last hurrah, you might say, the last attempt to get that return filed is putting it on paper. The tool, the IRS tool that I just mentioned to you, it does give you a personalized refund date after the IRS processes the return and approves the return. And then once they process it and approve it, then they're in a position to let you know when the refund will come. The application period for folks who are considered to be in a low income, there is a matching grant from qualified organizations, and that runs from August 22nd of this year to June 12th of this year. This requires additional work on your part to research this particular program. Okay, IRS has sent thousands of letters disallowing improper employee retention claims that IRC program, and again, that is that it does stand for the Employee Retention Credit, ERC. But that has been the area of the greatest abuse, you might say. So they are sending out all kinds of letters to notify them of the Employee Retention Credit that have been disallowed. The IRS is rejecting claims to all of the entities that actually did not exist or did not, or situations where the company has not really paid employees during the period of the of eligibility. But the letters are really part of an expanded compliance effort that includes a special withdrawal program for those with pending claims who realize that they may have filed an inaccurate tax return. So now, if you do realize that, or you have very, very uh, um, serious doubts that what you did file was in error, the IRS does have a way for you to, without damage to your reputation or to your bank account, they have a way for you to resolve that issue. And so they're urging employers who have currently put in a employee retention credit claim and to check out the withdrawal program that allows them to allows them to remove a pending ERC claim with no interest or penalty. Now, businesses with incorrect claims that have been paid can amend their return. The ERC, that is the Employee Retention Credit Voluntary Disclosure Program, actually has been closed since March 22nd of this year, but they may reopen the program later. The IRS is currently in another area, or more general area. They are helping taxpayers by providing penalty relief on nearly 5 million 2020 and 2021 tax returns with unpaid balances. Okay, let's be real here. When you file your return and then discover that you have not been able to avoid recognizing a liability, tax liability, and you haven't really taken any action on it. And so IRS, in a really, in an effort to help people who owe back taxes, IRS announced new penalty relief for approximately 4.7 million individuals, businesses, and tax-exempt organizations that were not sent automatic collection reminder notices during the pandemic. The relief will total about $1 billion, and most of those who are receiving this tax relief, have incomes that are under $400,000. Given the unusual situation due to the pandemic, they're doing these things in advance of their normal collection notices for those 2 years. So, and that's for the years that the pandemic years of 2020 and 2021. So for those particular years, the IRS is issuing a special reminder letter starting next month. They're taking steps to waive the failure to pay penalties for eligible taxpayers affected by the situation during 2020 and 2021. The penalty relief is automatic. You don't really need to take any action to get it. Okay, the next thing that I attempt to repeat during the regular program, but also every week, and that is this business regarding the 1099-K forms, reporting this is for folks who are in business and who have had over 200 transactions that amount to 20 grand, amount to $20,000. And so keep in mind that the threshold for this 1099K form is that those who received over $20,000, and it involved more than, you see that, remember I mentioned more than 200 transactions in 2023. Essentially, that a particular threshold has been delayed, and that change that I have mentioned in here would require that those people who have received the larger amounts of money of 20 grand and had over 200 actual transactions were required to to file, and it would apply just to those folks. But the change, this change has been put on hold, and it has been delayed again. So what IRS is doing is making a change at some point in probably the very near future to move from that threshold of 200 transactions or over 200 transactions and over $20,000 in total to just $600. And that would be moving that threshold back to what really has been used for just all 1099 forms. The $600 for more than $600 requires the self-employed person to report to IRS, include in their income, that income, and that amount should have been evidenced by a 1099 or 1099K form. So I'll keep this broadcaster will keep you up to date on that. Okay, IRS has announced that revenue officers, IRS revenue officers, have in the past made these unexpected visits to taxpayers. They're reversing a decades-long practice, of visiting households and businesses to collect unpaid taxes. They generally come as a team too. Generally, at least two arrive at the taxpayer's location, but effective immediately, those unscheduled visits will end, except in just very, very few unique circumstances. Okay, on to things that relate to the businesses. Keep in mind that for 2023, which is the tax year that we've just been through, that standard mileage rate was 65.5 cents per mile for business use. That would be for your car or van or pickup or panel truck, 65.5 cents per mile. Okay, what's news for the clean energy and energy credits? Well, new previously owned and qualified commercial clean vehicle credits was covered in the Inflation Reduction Act of 2022. And there were a number of changes, including fuel cell vehicles. IRS added a new credit for previously owned and commercial clean vehicles. With your comments and requests, this broadcaster we'll be happy to cover that area, because that's a very, very specialized area, and we'll be happy to cover that area in total. If you call in requesting that be done, and I'd be happy to, accommodate your request. Okay, the as far as green energy changes, the same act, an Inflation Reduction Act, they call it. Some people call it. I can guarantee that some people call it. To change that name, reduction. Some people call it the Inflation Increase Act 2022, but it's actually officially the Inflation Reduction Act. But there are a lot of changes and opportunities for those folks who took the effort and the bore the expense of making those improvements in your home setting. The For those who missed, for taxpayers who missed the last April 15th tax deadline, April 15th of 2024, IRS says file your return as soon as possible. You should do that just for those, for those situations where you owe money and you missed the deadline without requesting an extension. You should file quickly to limit your penalties and interest. For folks who are unable to pay their tax bill, which includes, I would say, a large percentage of the tax-paying public, IRS does have several options that's available to help. And as again, I mentioned that the options are very helpful, and this broadcaster will be happy to go over those options with your if you request that detail. Okay, disaster tax relief. Well, those individuals and businesses who've been affected by the terrorist attacks in the state of Israel on October 7th of last year, they have until October 7th of this year to file various federal returns, make tax payments, and perform other tax required actions. The folks who have been affected by severe storms and tornadoes that began December 9th, they have until June 17th of this year to file various individual and business tax returns, or if you owe money, to make tax payments. The dates actually that you're required to either file a return or make good on your tax liability have generally been February 15th. Or February 29th. I'm sorry, February 15th. Let me correct myself. You had until February 15th of this year. And that has been the date for all of the areas of the United States to get your return in and make payments. But I would say, and IRS is recommending, do that as soon as possible with an explanation. And if it's a sizable amount of money that you are claiming, it would be really, really practical to contact a tax practitioner in this endeavor. The folks who do not owe taxes, they generally can still claim key tax credits. The families and individuals who qualify, they can still file the 2021 tax return and do it without penalty for some or all of the recovery rebate credits, such things as the child tax credit, earned income tax credit, and other credits. IRS have already sent a letter out to 9+ million individuals and families who appear to qualify for a variety of these key 2021 tax benefits, but as of yet have not claimed them. So now the tax credits for families, keep in mind for 2023, it's likely that you're going to receive a significantly smaller refund compared to the previous year because the child tax credit, the earned income tax credit, and the child and dependent care credit, they revert to they revert to pre-COVID levels. Keep in mind that the child tax credit is, for 2022 and afterward is $2,000, but the child tax credit, the earned income tax credit, and the child dependent care credit, those were all expansions of that were made available through the 2017 Trump legislation. But those are all temporary increases in those tax credits, and those credits expire at the end of next year, 2025. So beginning on January 1st of 2026, all of those really, sizable credits that I've been talking about revert to what was the case before 2018. And so they'll be worth a lot less money for the earned income tax credit. Taxpayers with no children who receive roughly $1,500 in 2021 will now get $560 for 2022 tax return. The child and dependent care credit returns to a maximum of $2,100 in 2022 instead of $8,000 in 2021. So it's all of those credits, the extension of the credits, they sunset at the end of 2025. So beginning in 2026, they all go back to the previous levels of credit. There were no new stimulus payments for 2022. And that's very much unlike 2020 and 2021. There's no the above the line, as they call it, charitable deductions during COVID 2020 and 2021. Folks are able to take up to a $600 charitable tax deduction on their tax returns. However, for tax year 2022, taxpayers who do not itemize and who took the standard deduction, they will not be able to deduct their charitable contributions. And that really gets confusing because with all of these changes and the promotions that are being made by businesses, it's very, very difficult to keep up with that. For your information, and for the businesses that use what they call the Paycheck Protection Program, the PPP, use that for getting loans and not having to pay tax on them. If you did get a forgiveness on your PPP loan, you have to file an amended return that includes forgiven loan amounts in IRS. If you suspect that that was a incorrect filing of the filing for a loan, the if the IRS did issue some guidance in that area, and the IRS confirms that if your PP loan was forgiven based on misrepresentation or omissions, you cannot exclude that forgiveness from your income. So if you were in a situation where something was misrepresented on your original return, or you left out something, and then you realize that on that loan application, that you really cannot exclude the income because it was forgiven. You have to correct that with IRS, and so you have to include that forgiveness, in your income. If it appears as though the that special requirement, that special amount that was forgiven was actually based on a misrepresentation or an omission. So I would coordinate very, very closely with a tax professional on correcting that error that really many people fell victim to. Okay, so they can help. IRS does have all kinds of programs that it helps you to come clean, as you might say, with these special forgiveness programs, and so they do provide help in that respect. Okay, again, my phone number for questions and comments on the program, Everett James at 951 522 9877. And again, my email is evjtx1@gmail.com. This is a time to make any corrections for returns that have been filed, where you suspect or where it's very clear that you made a mistake, and because of that mistake on your return, you receive a special benefit or a special exemption, such as getting a 1099 showing that a part of the loan is being forgiven, and if that amount you just took for granted that was all able to get you allow you to avoid having to pay income on that forgiven amount. If you suspect that you took that credit incorrectly, and do something about it, come clean with IRS, they will not apply a normally much more rigid penalty. So that keep those things in mind. Okay, so the what can we? I'd like to share with you a comment about the spending for our health care. And there's a article that I extracted from the San Bernardino Sun that is entitled, Can We Afford Health Care for Undocumented Immigrants? It's written by The author of the column was written by Susan Shelley, who's a columnist for the San Bernardino Sun. This is dated January 7th, 2024. Can we afford all this health care for undocumented immigrants, particularly since many analysts um, have documentation that over 10 million of them have crossed into our country without vetting whatsoever. California is now providing, at this point, the state of California, I don't think this is true of all the states, but the state of California is providing a full scope of Medi-Cal benefits to undocumented immigrants or migrants, as they might be entitled. And that full scope Medi-Cal is called Medicaid in other states, but the full scope Medi-Cal covers primary and preventative care, covers specialists, prescription drugs, and other health services. Now, previously, the immigrants without legal status were eligible only for what they call restricted scope Medi-Cal. And that would, what is that? The restricted scope is benefits for such things as emergency room visits and pregnancy type care, pregnancy related care. But effective January 1st of this year, 2024, all California residents who meet the income eligibility requirements, regardless of immigration status, are eligible for what they call full scope Medi-Cal benefits. That's everything. So the policy was advanced piecemeal, that is in California. So beginning in 2016, full scope Medi-Cal benefits are granted to children under the age of 19, regardless of immigration status, as long as they met the other eligibility criteria. So that was expanded, expansion was expanded to young adults through age 25 in 2020. And 2 years later, the policy was expanded again to include anyone age 50 or older. So as of January 1st of this year, the missing group, adults who were aged 26 through age 29, became entitled to exactly the same full scope Medi-Cal benefits available to low income citizens and legal residents of California. Right now, there are approximately 14 million people, roughly 1/3 of the state's population in California on Medi-Cal. 1/3. California state officials said the latest edition could add another 700,000 people to the rolls and will cost about $3.1 billion per year. In truth, no one really has any idea how many people will be added to the rolls and what it's going to cost. Medi-Cal is an entitlement program. Everyone who meets the eligibility requirement is entitled to enroll in it. And then they're entitled to have Medi-Cal cover the cost of whatever medical services they need. The latest expansion, as I say, by lawmakers in California, included all these new applicants. Now, if lawmakers had taken the time to read the bill that they passed, this sentence would have jumped out at them. Quote, the federal Medicaid program prohibits payments to a state for medical assistance furnished to an alien who is not lawfully admitted for permanent residence or otherwise permanently residing in the United States. That means, what does that mean? That means that California will not receive, as a state, federal matching funds to help pay for the extension of this full scope Medi-Cal program. So who's paying for this? That's going to be California taxpayers. So, I mean, this is a very, very serious situation physically, and ethically. So to just complete this warning, the the Medi-Cal right now, what does it pay in comparison to say Medicare and then employer provided medical care? Right now, Medi-Cal only pays 52% of what Medicare pays for the same service. Um, so in 2017, there were only 13 million Californians on Medi-Cal. Now is 14 million, with an estimated 700,000 more eligible to enroll as a result. So this is currently, if California right now is currently facing a $68 billion budget shortfall. What's the plan? You can probably guess. On January 10th, the California Assembly Revenue and Tax Committee held a hearing, and what they're shooting as what they call a quote a wealth tax proposal. That would be through the constitutional amendment, and that would allow the legislature to define wealth and then tax it. So that's the reason you're hearing about so many people relocating out of California. Okay, with that warning, let's move into some other updates that you might want to be aware of. And since I have earlier talked about this out and repeated, but is there this the question has come from readers, is there a hardship exception to the 10% tax on early retirement payouts? Because this tax preparer, and I'm sure this is the same experience with other tax preparer services, that many of our clients have been hit with this 10% tax. If you have taken a payout from 401k or an IRA, and you were under that age of 59 and a half, and of course they took the tax payout just to deal with inflation, increases in the cost of living, and they took that payout. Well, the one example here of a lady who who withdrew $10,300 from her retirement plan in 2018 to pay rent and avoid eviction, and they took the payout, for an incredibly dire need just to maintain her residence. She was 59 and a half at the time of the withdrawal. And of course, her distribution got hit with the regular income tax, plus again, that 10% additional tax. And there wasn't really, how much she could do about it. Now, there is some limited relief for post 2023 early withdrawals used for what they use for emergency, and you have to establish, the nature of the emergency. Recent legislation called Secure 2.0 lets people under 59 and a half take one annual payout each year up to $1,000 from IRAs or 401ks for emergency personal expenses without paying that 10% fine. So I'm sure this is going to be subject of amendments for many folks. If you fall into the category of taking a payout from your 401k or an IRA, contact your tax professional to verify or to see if you got hit with that a penalty for taking the payout before reaching age 59 and a half. But keep in mind that there may be some limited relief from that penalty. The new tax law, Secure 2.0, it does let folks under 59 and a half take one annual payout each year of up to $1,000 from an IRA or 401k for an emergency personal expense without paying the 10% penalty. The IRS rules require that the emergency distribution has to be for unforeseeable emergencies, has to be for immediate financial needs, and it has to be related to the necessary personal or family emergency expenses. Be happy to repeat that next week and keep repeating it because it really does. Just from my tax preparation business, that has occurred in many taxpayer situations. Okay, for those who have been blessed enough and wise enough to set up health savings accounts, HSAs, the annual ceilings or limits on those deductible contributions, that goes up. That's going up next year in 2025, and it's increasing to $4,300 with account owners who have just self-only coverage, and it goes up to $8,500, $8,550 for those with family coverage, and again, $4,300 for self-only. I assume that covers just for single folks, and up to $8,500 with family coverage, and that's for 2025. People who were born before 1971, you can put in an additional $1,000. That's beginning next year. Eligibility for health savings accounts is restricted. You want to keep keep that in mind. You have to have a high deductible health plan, and the minimum policy deductible for 2025 goes up to $1,650 for self-only coverage, and goes up to $3,300 for family coverage. Also, another point, also your out-of-pocket costs, including co-payments, cannot exceed $8,300 for individual coverage and $16,600 for family coverage. Folks who are enrolled in Medicare do not have these high deductible health plans, and they cannot contribute to an HSA. So if you have Medicare, that is not going to work for you. You won't be able to set up this type of a plan, that health savings account. Okay, are any of you in the listening audience, have you claimed or planning to claim a tax credit for the purchase of a new or a used electric vehicle? Well, be sure to include the correct vehicle identification number on your Form 8936, Schedule A, Line 2, or IRS can automatically deny the credit and adjust your taxes. Again, be sure that if you did apply for that credit for a new or used electric vehicle, that information was provided. And you can, of course, if you haven't heard from IRS, certainly contact your tax professional to get an amendment in immediately. Keep that in mind. For folks who are involved with churches that are exempt from withholding FICA from their clergymen. They there is a special procedure for that. So instead of paying FICA, they generally pay self-employment tax just on their ministerial wages, and they do that by completing Form SE, self-employment, with their tax return and paying the SECA tax. Clergy who are opposed to Social Security, they can get the self-employment tax exemption, but it's not automatic. You have to take a vow of poverty, and then you have to file a Form 4361 or by a letter, which has to be approved by IRS. And I would certainly advise against taking that break without getting approval from first a written approval from IRS. The exemption that you get continues each year, and it is irrevocable. Some clergymen who got this one-time irreversible exemption, also now they say they want to receive Social Security and Medicare benefits. That's not possible at the moment, but there is a bipartisan bill in the Senate. If they did, the Senate is at least some groups in the Senate are considering a bill that would provide a re-enrollment window to let clergy back into the Social Security system. That would be a huge break for clergy who took the step of taking that vow of poverty and now want to get back into the Social Security program. Okay, folks who, and this applies to folks who may be in the same business as this broadcaster. Watch out for cyber thieves. They're scamming tax professionals, and they really have become increasingly sophisticated. They're looking for sensitive, prepared information such as your CAF number. That's that centralized authorization file number. To stem the tide of these cyber thieves, IRS is taking two-step actions. They're in the process of suspending CAF numbers that it suspects are compromised. So it's not going to be something that affects all tax preparers immediately, but for those of us who may have been scammed, and IRS recognizes that, what would happen? What IRS will do? They'll suspend the number if they think that, as I say, we got compromised. Tax professionals who face this issue will hear from IRS, and after going through heightened security procedures, they will get new. They can't get new CAF numbers. Another thing that is facing the tax professional population in the country, they are facing new security measures in trying to get transcripts for clients. All tax professionals who order federal tax transcripts for their clients by telephone have to call the IRS's practitioner priority service to ask that those transcripts be deposited into their secure object repository mailbox. And there's no other IRS phone lines will be available for this purpose. So whoever calls will face enhanced security questions. If the operator on the PPS phone line cannot verify the caller's identity, the agency won't immediately deliver the transcripts as requested, but instead they'll mail it to the taxpayer's address on record, which of course that's going to take a lot more time. So it's it's something that you want to be aware of. Now, I have talked in this area before, and that is the area of hobby losses. Why is this such an important area? Because in this area of the gig economy and the side hustle, in this particular, since so many people are involved in picking up a side hustle job and are having questions about what to report, how much do they report, how do they substantiate any expenses in order to reduce the tax liability. In fact, I think this might be, a good time to announce to our listeners that we are going to designate the following few weeks on just that issue of record keeping for your side hustle, side jobs, and the reporting requirements that the IRS imposes, and the areas that you want to, avoid or at least approach with a great deal of caution. And one of those areas is, could this activity that you're involved in just be a hobby with no real profit motivation? Because in order to deduct those expenses, there has to be a clear profit motivation. And the current safe harbor, you might say, or the current and long time rule is, if IRS sees that you've made a profit in 3 of the past 5 years, then they consider you to have been motivated by a profit motivation, and you can, under those circumstances, deduct those expenses. But if it appears that you fail to meet this test, and say 3 of the past 5 years, you haven't made a profit, and are using the loss from that side business to offset your other income, your wage income, or maybe investment income. You're just using it as a way to write off your other income. They will consider you and change your category to just a hobby business, and there you'll still be able to deduct expenses, but only up to your income. You will not be able to claim a loss, and I'm certain that situation applies to an increasing number of folks who have a side business. In one situation, a taxpayer had 15 straight years of losses. 15 straight years. And he was in the business. He was an avid hunter and had a hunter profit motive argument. Yeah, the argument sounded good. He was actually a real estate developer who years ago began conducting what they call an ecotourism operation on a portion of land that he owned in Texas. And boy, this type of activity is really, really, really prevalent in the southwestern part of our country, the hunting areas. But the activity consisted of selling packages for hunting, for hunters, for fishing, for fishermen, and other events. And for years, he claimed big losses on the Schedule F that actually offset and it just so happened that those losses just happened to offset neatly the income from all the other sources of income he had, from the job and from investments. So that it went to a tax court. They analyzed factors for determining whether an activity is engaged in for profit, and decided that the 3 that were most significant, and decided that taxpayer did not again have an actual and honest profit objective. His objective was just offsetting the other income. Um, it really did provide a lot of personal pleasure. And they also found that he did not carry on the activity in a business-like manner. So at the end of the day, the court agreed with IRS's disallowance of the losses. That could happen and is going to be happening, on an increasing, basis over in the future. So you want to keep track of that. Okay, IRS can assess